So hello everyone, welcome to the Monkey Stock Club. For those who are new at this channel, my name is Monkey B. I love to go out there and finding some nice stocks just for you. So all you have to do is just watching this video and decided if the following stock could be something for your portfolio. So please feel free to hit the subscribe button below and become part of the Monkey Stock Club family, so you will never miss a video again. Please be aware that everything I say here is just my opinion, as I'm not a professional investment advisor. As you can see, I'm just a monkey, but nevertheless, I love to analyze stocks for you. So let's stick around and discuss it now. Let's talk about Apple. To analyze Apple, I use the high growth investing strategy. So first, an HGI score is calculated for the selected share according to a simple points system. The HGI score consists of 6 criteria or 6 KPIs for which 1 to 3 points are awarded, and in total, a high growth stock could achieve or receive a maximum of 18 points. So the first KPI is the enterprise value divided by the sales actual. So we have 7.4. As we are below 8, we received 3 points for Apple. And the enterprise value is a measure of the value of a company regardless of its financing. And if you divided the enterprise value by sales, you get an important ratio of the estimating valuation of a fast growing but sometimes loss making technology company. So in case of Apple, we have also seen here a screenshot from Yahoo Finance, 7.02. I calculated 7.4 as I used the market capitalization minus cash plus debit. 2 billion US dollar divided by 2.7 billion revenue, so we end up at 7.4, 3 points for Apple. The second KPI, the cross margin, if we talk about the cross margin, it's the percentage of the sales that remains with the company after reducing the direct costs. So it's a good indicator of the profitability of a business model, and the higher the percentage, the more money a company has available for sales and other activities like development and research and marketing. So in case of Apple, the sales minus direct costs divided by sales, we end up around about 37% overall. So unfortunately 0 points as we are below 50%. The next one, rule of 40 within the last 12 months. So it's a simple key figure for assessing the efficiency of a company growth and also the quality of the business model. The ratio is calculated as the sum of the sales growth rate and the free cash flow margin. So if we do that, we end up at around about 32%. That's below 40, so 0 points. Next one, the sales growth, 5.6%. 0 points as we are below 20. Here you can see also a screenshot of the financials, the revenue and the earnings. Quite a good development from 2016 to 2018, then a minor decrease in revenue and earnings. So 0 points. The debit ratio, 1.69. As we are bigger than 1.5, we didn't receive any points, so 0 points. the debit last quarter, 1.2 billion divided by 72,000 million, so we end up at 1.6. And last but not least, the PEG within the last 12 months is one of the most important key figure for the assessment of an already profitable growth stock. So it calculates the ratio of the price per earnings and the profit growth. And if the ratio is between 0 and 1, as Peter Lunch already mentioned, it's an indicator for an undervaluation. And yeah, that means that the stock is quite cheap at the current circumstances. So the PEG can only be calculated for companies that are already sustainably profitable. So in case of Apple, we have an PE TTM of 33 divided by 4.5%. So we end up at around about 7.3. So bigger than 4, so 0 points. Here below you see the overall sales growth within the last 3 years. So 2019 was with a minus 2.2%. And as Apple also reported the last quarter figures, the share fell more than 4% in extended trail after the tech giant reported 60% decline in iPhone sales and failed also the offer to offer the investors any guidance for the future. So overall, not such a nice result. So last but not least, the question: would I buy Apple currently, as we have a current price, a closing price at around about 110? So I also use the fair value of Peter Lynch. So the EPS estimation, as we can see here, 3.24, and for next fiscal year 2021, 3.9. So we talk about around about 20% profit growth, multiply by the EPS 2021. So we end up at a fair price of round about 80 euro, so minus 28%. So that is why I would assume that we will see a consolidation within the next months. But yeah, who knows at the end of the day. And especially, or let's say according to the HGI score 3, it's also an indication that we are not talking about a high growth stock for Apple. So I hope you enjoy the video. Please hit the subscribe button below. I would really appreciate it if you do so, to become part of the Monkey Stock Club family, and you will never miss a video again. That would be great, and it helps me to build up a nice community here. So then, have a nice day. Bye bye.